Right now, there is a company out there posting 43.5% year-over-year revenue growth. We are talking about a business landing massive Fortune 1000 enterprise contracts, reporting net revenue retention rates that rival the best software platforms in the world, and generating tens of millions of dollars in free cash flow. Under any normal circumstances, Wall Street would price a company like this as an absolute elite AI infrastructure asset, but they aren't. Right now, this company is trading at a heavily discounted ad tech multiple, priced as if its entire underlying foundation could just collapse tomorrow. And the reason? There is a ticking legal time bomb sitting in a New York federal court. That is the fundamental disconnect at the very heart of Zeta Global Holdings. On one side of the ledger, you have elite SaaS-like growth. Their revenue just surged 43.5% in the latest quarter alone. But on the other side, you have a deeply distressed valuation. Zeta is currently trading at a forward enterprise value to revenue multiple of roughly 2.5 times. To really put that into perspective, enterprise SaaS peers growing at similar 25 to 30% rates are trading anywhere from 8 to 12 times forward revenue. It's a massive gap.
Section 1. The valuation disconnect. So, to understand this incredible valuation disconnect, we have to ask the multi-billion-dollar question. Is Wall Street just entirely mispricing a foundational AI infrastructure stock because they're trapped by legacy definitions of what this company used to be? Or is there a hidden structural risk waiting to wipe out their entire competitive moat? Let's start with how they actually make money, because this dual revenue architecture is exactly where the market's historical misunderstanding usually begins. Historically, Wall Street has classified Zeta as an ad tech provider, or maybe an agency hybrid. But look at their actual revenue breakdown today. Approximately 70% of their revenue is driven by multi-year subscription software contracts. These are agreements with defined, committed minimums for access to their core database, their CRM, and their analytics software. They sell this cloud technology directly to Fortune 1000 brands and mid to large enterprises. The remaining 30% of sales? That comes from usage-based and campaign performance fees tied to messaging volume or lead outcomes. By controlling the data foundation and the distribution lines directly, Zeta completely bypasses the heavy intermediary markups of legacy ad exchanges.
Section 2. The AI Growth Engine.
So what is actually driving this massive scale? Why are enterprises ditching entrenched legacy systems and plugging directly into Zeta's platform? Well, it comes down to a competitive moat built on two proprietary pillars, the Zeta SuperGraph and Athena AI. The SuperGraph is a deterministic identity resolution system. That basically means they know exactly who you are across devices. They aren't just guessing based on third-party cookies. It's an in-house data lake containing 245 million US profiles and over 535 million global profiles. And crucially, they aren't renting this data, they own it. They aggregate roughly 2,500 individual attributes per person, synthesizing 1 trillion monthly content signals. And then they layer on Athena. This is their agentic conversational AI interface. An enterprise client can just use natural language prompts to instantly generate complex audience segmentations and execute coordinated omni-channel campaigns across the open web. Because the platform is natively pre-populated with all those consumer profiles, clients don't have to spend months importing external identity graphs like they do with legacy clouds. It dramatically lowers the total cost of ownership.
And once an enterprise integrates its proprietary CRM and customer data into Zeta's platform, the switching costs are absolutely immense. Moving to a competitor involves heavy operational friction, data migration risks, and huge model retraining expenses. This incredible stickiness resulted in a net revenue retention rate of 120% in fiscal 2025. What that tells us is that once these companies plug into this AI infrastructure, they simply do not leave. In fact, they utilize a land and expand motion, starting with a single marketing module and scaling up usage dramatically over time.
You could see this operational momentum on full display when Zeta reported its second quarter 2026 financial results on August 4, 2026. Management actually marked this as their 20th consecutive public beat and raise quarter. Total revenue came in at $442.7 million, beating consensus estimates by 5.3% and growing that massive 43.5% year-over-year. Free cash flow surged 73.1% to $58 million, which represents a very healthy 13.1% margin. The company even generated a positive GAAP net income turnaround of $8.2 million. But there was a flaw in the print. Non-GAAP adjusted earnings per share came in at $0.18, which missed the analyst estimate of $0.2. This was primarily driven by higher-than-expected cost of revenues, which rose to absorb programmatic inventory and all the expenses related to their recent $325 million acquisition of Marigold's enterprise business.
And despite management raising their full-year 2026 revenue guidance to over $1.8 billion, the market ruthlessly punished that EPS miss.
During the regular session, right before earnings, the stock had climbed 7.5%, but immediately following the after-hours release, shares dropped 7.05% to settle at $22.55. Investors showed extreme sensitivity to operating profitability and the costs of integrating these massive acquisitions. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed.
Section 3. The Central Conflict.
Now, an earnings miss on integration costs doesn't fully explain a 2.5x multiple for a software company growing at 43%. It just doesn't. To understand the real anchor weighing down this stock, we have to pivot sharply to the existential threat that is absolutely terrifying institutional investors. The central conflict lies in a federal securities class action lawsuit currently sitting in the Southern District of New York. The timeline here is critical. Back in November 2024, a short seller report alleged that Zeta misrepresented the size and the opt-in consent status of that massive 245 million user database we just talked about. They claim Zeta utilized predatory consent farms and circular data swapping contracts to artificially inflate revenues. Now, Zeta strongly denied all of these allegations. But then, on July 8, 2026, Judge Dale E. Ho officially denied Zeta's motion to dismiss the case, ruling that plaintiffs adequately alleged materially misleading statements regarding their data collection practices. The litigation has now entered the discovery phase.
And this brings us to the ultimate bear case. The risk here isn't just a one-time fine. With tightening privacy regulations like California's CPRA and Europe's GDPR raising the standards for what constitutes valid consumer consent, the real fear is structural data deletion. If court findings or regulatory actions require Zeta to delete massive portions of its database collected under contested opt-out frameworks, like their Discus network, for example, the entire AI-driven platform loses its utility. The data moat literally becomes a legal liability.
Section 4. The Zeta Scorecard. So how do we objectively weigh these competing forces? You've got massive, verified AI-driven revenue growth on one hand versus a structural, potentially company-altering legal risk on the other. Looking at the qualitative business scorecard, we see a really fascinating split. Management alignment scores an 8 out of 10. Following that initial short report, CEO David Steinberg and other directors stepped right up and completed over $3 million in personal open market share purchases. That is serious insider conviction. The growth outlook is a stellar 9 out of 10, significantly bolstered by a 7-year strategic partnership with Palantir Technologies. That deal integrates Zeta's data cloud with Palantir's Foundry, projecting over $100 million in annual revenue upside alone. But then we hit business viability, which drops down to a 6 out of 10, entirely tied to the SDNY litigation and the uncertainty around those data collection practices. Overall, this nets out to a blended score of 7.6 out of 10. It is a highly robust but deeply constrained business right now.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. It also includes Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, tracking meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Section 5. 3 future scenarios.
Okay, let's establish the financial framework for how this highly asymmetric risk profile could actually play out in the market over a 5-year holding period, projecting out to fiscal year 2031. But before we break down the math, I need to state this clearly. This is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. For this model, we're going to use free cash flow multiples for our valuation basis, simply because it's the most reliable metric for software companies with high non-cash stock-based compensation.
We'll start with the base case, to which we're assigning a 50% probability. In this scenario, Zeta just maintains its normal enterprise customer additions and expands its mid-market footprint. Revenue grows at a compound annual rate of 16%, reaching $3.8 billion by year 5. They hit management's target free cash flow margin of 16%, yielding roughly $610 million in annual cash generation. We assume a 2% annual share dilution, and we assume the market decides to keep Zeta at its current, relatively constrained valuation profile of 20 times free cash flow. This gives us an implied market cap of $12.2 billion, resulting in a future share price of $44.45. That is a very solid 14.5% annualized return from current levels.
But what happens if they execute flawlessly and finally shed that ad tech stigma? In our high case, which carries a 30% probability, things get incredibly exciting. Zeta successfully integrates the Marigold and LiveIntent acquisitions, and that Palantir partnership drives massive, sustained enterprise contract wins. Revenue scales at a 22% CAGR to $4.9 billion. The FCF margin expands to a highly profitable 18%. And because cash generation is so strong here, they aggressively buy back shares, limiting dilution to just 1% annually. Most importantly, the market re-rates Zeta to a 25 times FCF multiple, finally valuing it as a true enterprise AI infrastructure platform. The implied share price explodes to $84.49, delivering an incredible 30.2% annualized return.
However, we absolutely have to quantify the downside. In the low case, carrying a 20% probability, the thesis breaks. An adverse legal judgment in the SDNY, or a brutal regulatory shift, forces major data deletion. This sparks heavy client churn. Revenue growth collapses to an 8% CAGR, hitting just $2.6 billion in year 5. Margins compress to 11% due to massive compliance costs and lost scale. The company has to issue equity to offset lower cash flows, driving a 4% annual share dilution. Consequently, the market brutally compresses the valuation multiple down to 12 times FCF, pricing it as a declining legacy ad tech asset. In this scenario, the share price gets cut in half to $11.64, representing a negative 12.4% annualized return.
Section 6. Risks and the final verdict. That brings us to the final synthesis. When you run those scenarios, a blended, probability-weighted expected target price lands at roughly $49.90. The upside is incredibly asymmetric, yes, but the risks are concrete and potentially devastating. So, what are the specific early warning signs investors must actively monitor? There are 3 strategic triggers to watch. Number 1, and the most urgent, the SDNY discovery disclosures. Any negative leaks regarding their consent practices could permanently damage the data moat. Number 2, net revenue retention. If NRR falls below 110%, it is a blaring siren that the integration of the $325 million Marigold asset is failing, and cross-selling synergies just aren't materializing. And number 3, macro advertising retrenchment. Zeta operates with a highly competitive customer acquisition cost payback period of 79.3 months. But if corporate marketing budgets suddenly tighten due to elevated interest rates or recession fears, that long payback model could quickly become financially unsustainable. Look, Zeta Global is posting the kind of 43% top-line growth and cash conversion that growth investors dream of. They are fundamentally shifting how Fortune 1000 companies execute AI-driven marketing. Yet, it trades at this massive discount because the market is terrified that its foundational 245 million profile database is a legal liability rather than an impenetrable moat. If management can navigate the SDNY discovery phase cleanly and continue integrating their massive enterprise acquisitions, the multiple expansion opportunity here is immense. But if their core data practices are forced to change, the entire foundation cracks. So, you have to ask yourself, is Zeta's data moat an impenetrable fortress or a massive legal liability? If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.StockSentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.StockSentinel.ai to access free research and videos like this one for any company in the world.